A silent shift is happening in the world of money, and most people have no idea it is already underway. The two countries that once funded America more than anyone else are quietly stepping back. China and Japan, the biggest foreign buyers of U.S. debt for decades, are reducing their holdings of U.S. Treasury bonds. This is not loud. This is not dramatic on the surface. There are no emergency meetings on television, no breaking news banners, but behind closed doors, balance sheets are changing, and those changes could affect interest rates, currencies, markets, and even everyday loans across the world. The global financial system runs on trust, and that trust has always pointed toward one place: U.S. Treasuries. Now, the biggest supporters of that system are slowly pulling away, and very few people are talking about what this really means. For years, U.S. Treasury bonds were seen as the safest place on earth to park money. These bonds are simple in idea. The U.S. government borrows money and promises to pay it back with interest. In return, countries, banks, and investors buy these bonds and hold them as reserves. It is like lending money to the most trusted borrower in the world. That is why central banks across the globe stored hundreds of billions of dollars in these bonds. China did it, Japan did it, Europe did it, oil-rich nations did it. This system helped the United States borrow cheaply, and it helped other countries keep their wealth in a stable place. It became the backbone of global finance. But now this backbone is starting to bend in ways that most people do not yet understand. China once held well over $1 trillion in U.S. Treasuries. Japan still holds around that level, but even Japan has adjusted its position at times. What matters is not a sudden sale. What matters is the direction. The direction has changed. China's holdings have dropped to levels not seen in many years. Instead of buying more U.S. debt, China has been buying gold, investing in other currencies, and spreading its reserves across different assets. This is not a random decision. It is part of a long-term plan to reduce dependence on the U.S. dollar. At the same time, Japan, the largest foreign holder of U.S. debt, has also made moves that show caution rather than blind loyalty. These are not emotional decisions. These are strategic decisions taken after years of watching global politics, trade conflicts, sanctions, and rising U.S. debt levels. This matters because U.S. Treasuries are not just pieces of paper. They influence mortgage rates, loan costs, credit markets, and the strength of the dollar itself. When demand for these bonds falls, the U.S. government must offer higher interest to attract buyers. Higher interest on government debt slowly spreads into the entire economy. That means higher borrowing costs for businesses, higher interest on home loans, and tighter financial conditions across markets. What starts as a quiet change in foreign reserves can eventually touch ordinary lives in unexpected ways. This is why the shift by China and Japan is far more important than it looks at first glance. There is another layer that makes the story even more serious. For decades, the U.S. dollar was the unquestioned reserve currency of the world. Most global trade happens in dollars. Oil is priced in dollars. International loans are issued in dollars. This gave the United States enormous financial power. But countries have learned from recent geopolitical events that relying too heavily on one currency can be risky. Sanctions, trade wars, and political tensions have shown that access to the dollar system can become a tool of pressure. As a result, many nations are now looking for alternatives. China's move away from U.S. Treasuries is not just about money. It is about control, independence, and protection from future risks. Japan's careful adjustments show that even close allies are watching the situation closely. In this video, you will learn what U.S. Treasury bonds really are and why they became the world's safest asset for so long. You will understand why China started reducing its holdings and why this trend has continued year after year. You will see why Japan's position is just as important, even if the changes appear smaller. You will discover how these decisions are linked to gold buying, currency shifts, and global political tension. You will also learn what could happen if more countries follow the same path and what that means for the future of the dollar, global markets, and everyday financial life. Most importantly, you will see why this is not a sudden crisis, but a slow transformation that is already in motion. By the end of this video, the quiet actions of central banks will make much more sense. The numbers on financial reports will connect to real-world consequences. The reasons behind these moves will feel clear instead of confusing. And the bigger picture of how global finance is evolving will become easier to understand. This is not just a story about bonds or foreign reserves. This is a story about how power in the financial world slowly shifts without headlines, without panic, and without most people noticing until the effects are already visible. Stay with us until the end, because each piece of this puzzle builds on the next, and the full picture only appears when all the parts come together. Welcome to our channel, where we break down complex global events into simple explanations that anyone can follow. If you want to understand how money, power, and global decisions shape the world around you, make sure to subscribe and join us for more deep and clear insights like this. Numbers on government reports often look dry and distant, but these numbers tell a powerful story about who really funds the United States. For many years, two names stood at the top of that list without competition: Japan and China. These two countries together held more than $2 trillion in U.S. Treasury bonds. That is an amount so large that it quietly helped the United States borrow money at low cost for decades. Japan has been the largest foreign holder for years, with holdings that crossed $1 trillion. China followed closely behind for a long time, sometimes very close to Japan's level. These positions were not accidental. They were the result of years of trade, export earnings, and careful reserve management by their central banks. When these countries sold goods to the United States, they earned dollars. Those dollars had to be stored somewhere safe. U.S. Treasuries became that safe place. Over time, this system created a cycle. The United States bought products. China and Japan earned dollars. Those dollars returned to the United States in the form of loans through Treasury bonds. This cycle became one of the most important financial relationships in the modern world. Other countries also hold large amounts of U.S. debt. The United Kingdom, oil-exporting nations, European economies, and financial hubs like Luxembourg and Switzerland all keep significant treasury reserves, but none of them match the scale of Japan and China. These two were always watched closely by financial analysts because even small changes in their behavior could signal bigger shifts ahead. When Japan or China added more treasuries, it showed confidence. When they reduced their holdings, it raised questions. For years, the general trend was steady or growing. That is what made the recent changes so important. The direction began to shift, slowly at first, then more clearly over time. China's position began to change in a noticeable way over several years. Instead of increasing its holdings as it had done before, China started reducing them bit by bit. There was no sudden dump, no dramatic one-day sale. The numbers simply showed a steady decline. Year after year, the total amount of U.S. Treasuries held by China moved lower. Eventually, these holdings reached levels not seen in nearly 17 years. This was not a small adjustment. This was a long-term pattern. Financial observers noticed that while China was reducing U.S. debt, it was increasing purchases of gold. It was also diversifying into other currencies and assets. This shift was not random. It followed careful planning by Chinese financial authorities who wanted to reduce dependence on the U.S. dollar over time. Gold became a key part of this story. Central banks around the world began increasing gold reserves, but China was one of the most consistent buyers. Gold does not depend on any government. It cannot be frozen by sanctions. It does not carry political risk in the same way bonds do. By increasing gold reserves while reducing U.S. treasuries, China was slowly changing the structure of its financial safety net. At the same time, China promoted trade agreements that used its own currency instead of the dollar. Each of these steps may look small on its own, but together they show a clear direction. The goal was to build more independence from the US-centered financial system. This change was not caused by panic. It was not the result of a single crisis. It was part of a broader economic strategy. Chinese policymakers understood that holding too much of one country's debt creates vulnerability. If relations become tense or if financial sanctions are used, those reserves can become a point of weakness. By spreading reserves across gold, other currencies, and different assets, China reduced that risk. The steady nature of the reduction shows patience and planning rather than fear. This is what makes the shift more serious. It is calm, controlled, and deliberate. Japan's role in this story is equally important, but for different reasons. Japan remains the largest foreign holder of U.S. Treasuries. Its holdings still hover around or above $1 trillion. Japan has not reduced its position as dramatically as China, but there have been periods where Japan trimmed its holdings, followed by periods where it increased them again. These adjustments often relate to currency management. When the Japanese yen weakens, Japan may sell some treasuries to support its currency. When conditions stabilize, it may buy again. This pattern shows that Japan uses its treasury holdings as a financial tool rather than simply a passive reserve. Tokyo understands that its position gives it influence. Holding such a large amount of U.S. debt can act as a form of leverage in international discussions. This does not mean Japan threatens to sell. It means Japan knows that its financial relationship with the United States carries weight. The stability of this relationship has been important for both countries for decades. But even Japan has become more cautious. Rising U.S. debt levels, changing global conditions, and shifting economic priorities have made Japanese policymakers more careful about how much exposure they want to maintain. One of the main reasons both countries are reducing or adjusting their holdings is diversification. No investor, whether a person or a country, wants to keep all wealth in one place. For a long time, U.S. Treasuries looked like the perfect place. They were safe, liquid, and reliable. But over time, the idea of keeping such a large portion of national reserves in one asset started to look risky. Diversification became the logical step. This meant buying gold, holding more euros or other currencies, investing in infrastructure projects, and supporting domestic financial markets. The goal was simple: spread the risk. Geopolitical tension added another reason. Trade disputes, tariffs, and sanctions changed the way countries viewed financial dependence. When economic disagreements turned into trade wars, it became clear that financial systems could be used as tools of pressure. Countries that relied too heavily on dollar assets began to rethink their strategies. Holding U.S. debt meant being deeply tied to the U.S. financial system. Reducing that tie offered more freedom to make independent decisions without fear of financial consequences. There is also concern about the long-term value of the dollar. The United States has accumulated very large amounts of debt over the years. To manage this debt, more bonds must be issued. When supply increases too much, investors worry about value. If confidence in the dollar weakens, the real value of Treasury holdings can fall. Countries holding these bonds understand this risk. By reducing exposure slowly, they protect themselves from potential future losses. China's steady reduction and Japan's careful adjustments show that this is not a temporary reaction. It is part of a larger global shift. Central banks are watching each other. When one major country changes strategy, others take note. As more countries buy gold and diversify reserves, the dominance of U.S. Treasuries as the single safest asset begins to soften slightly. It does not disappear, but it no longer stands alone without alternatives. This entire process happens quietly. There are no loud announcements. The data appears in monthly reports that few people read, but these reports reveal a pattern that grows clearer with time. The biggest foreign supporters of U.S. debt are no longer increasing their support in the way they once did. Instead, they are building safety nets that do not rely so heavily on the dollar. This is how financial power slowly shifts, not through sudden shocks, but through patient, steady decisions made over many years. The sudden aggressive sale of U.S. Treasury bonds by the two largest foreign holders would send shockwaves through financial markets in a way that few people fully understand. Treasury bonds work on a simple rule of supply and demand. When many buyers want them, prices stay high and interest rates stay low. When large sellers enter the market at once, prices fall quickly. As prices fall, yields rise. Yields are another word for interest rates. This means the U.S. government would have to offer higher interest to attract new buyers. That higher interest does not stay limited to government borrowing. It spreads into the entire financial system. Mortgage rates would climb. Car loans would become more expensive. Business loans would cost more, credit card interest could rise. The effect would travel from bond markets into everyday life without most people realizing where it began. Financial markets react quickly to large movements. If China and Japan suddenly released hundreds of billions of dollars worth of treasuries into the market, traders would panic. Prices would drop faster because others would rush to sell before losses grow. This kind of reaction creates a chain effect. Investors would move money into other assets. Stock markets could fall due to fear and rising borrowing costs. Currency markets would become unstable as investors reassess the strength of the dollar. Even countries far from the United States would feel the pressure because their economies are linked through trade and finance. Banks and pension funds across the world hold U.S. Treasuries as safe assets. A rapid fall in bond prices would reduce the value of their holdings. That loss in value could tighten credit as institutions become more careful with lending. Businesses planning expansion might delay. Consumers might postpone big purchases. Governments with dollar-based reserves would see changes in their balance sheets. All of this could happen in a short time if selling were fast and uncontrolled. Higher U.S. interest rates would also increase the cost of servicing America's own debt. The United States already spends large amounts on interest payments. If rates rise sharply, that cost grows quickly. This could force difficult decisions in government spending and borrowing. Markets would start asking deeper questions about sustainability. Confidence, which is the foundation of financial systems, would face pressure. But this extreme situation is not what current data shows. The reductions by China and adjustments by Japan have been slow and measured. There has been no sign of panic selling. Monthly reports show gradual changes, not sudden drops. Other buyers, including private investors, banks, and institutions, continue to purchase U.S. Treasuries. Demand for these bonds remains strong because they are still considered among the safest assets in the world. Even as China reduces its share, total foreign holdings remain in the trillions. This is an important detail. The global system has many participants. If one country sells, others often buy. The U.S. bond market is deep and liquid, meaning it can absorb large amounts over time without breaking. This is why the shift by China and Japan has not caused immediate disruption. The process is slow enough for markets to adjust. New buyers step in. Prices remain relatively stable. Interest rates move, but not in a shocking way. Foreign governments, central banks, and large institutions still trust the safety of U.S. debt. The dollar remains the main reserve currency. Global trade still depends heavily on it. Oil is still priced in dollars. International contracts still use dollars. These realities support ongoing demand for treasuries even as some countries reduce their exposure. The system is not collapsing. It is adapting. What is changing is the pattern. Instead of automatic growth in foreign treasury holdings every year, there is now a mix of buying, holding, and slowly reducing. This creates a different long-term picture. The United States may rely more on domestic buyers. Interest rates may slowly trend higher over time if foreign demand does not grow as before. These changes happen quietly and gradually. China and Japan are not acting out of panic. They are adjusting to a world that looks different from the past. Economic power is spreading across regions. New financial alliances are forming. Gold purchases by central banks are rising. Trade agreements are being made in local currencies. These steps reduce reliance on any single system. The dollar still dominates, but alternatives are being built in the background. This evolution does not produce loud headlines. It appears in data tables, policy speeches, and reserve reports. It unfolds over years rather than days. Observers who look closely can see the direction, even if the pace is slow. The largest holders of U.S. debt are becoming more cautious and more diversified. That choice reflects a broader view of risk and independence in a changing global landscape. As this process continues, global finance becomes more balanced across different assets and currencies. The role of U.S. Treasuries remains central, but it no longer stands without competition. The actions of China and Japan show that even the strongest financial habits can change when conditions evolve. The future of global reserves may look more spread out, with gold, multiple currencies, and different assets sharing space that was once dominated by U.S. debt alone. The story you just heard is not about numbers on a screen. It is about a quiet shift in how the world manages money, trust, and power. China and Japan are not making noise, but their decisions are sending signals that careful observers cannot ignore. The dollar still stands strong at the center of global finance, but the way countries treat U.S. debt is slowly changing. These changes may take years to fully unfold, yet the direction is already visible for those who look closely. Now, the question moves to you. Do you think the dollar will continue to rule the global system without challenge, or are we watching the early stages of a new financial balance? Share your thoughts in the comments. Your view matters, and this conversation is just getting started. If you found this breakdown clear and helpful, support the channel by liking this video, sharing it with others, and subscribing for more simple explanations of complex global topics. Stay connected because the world of finance is changing quietly, and we will keep bringing these hidden shifts into the light.